What's up, everybody? Michael Silva here. Are we moving from stage 6 into stage 1, the contractionary phase, where bonds start performing well, but stocks, commodities continue to go down? I got some interesting data to go over today in today's stock market brief. I hope everyone enjoyed their Thanksgiving and got to spend some time with their friends and family. Now, I want to start this off by saying that typically right now we're in a period of seasonality where the market does good, right? You have holiday trade, which typically lower volume. You typically see some sort of Santa Claus rally, right? Going into end of December like we did last year. You get month-end markup, you get quarter-end markup, you get holiday trade. So that's something that we always got to be prepared for. Also to note, the market has been very dependent on data drops, and we have a lot of data coming out, not only this and the remainder of this month, but we have it coming out next month. Next month is going to be really big around this time, December 14th, where we had the Fed interest rate decision and then inflation numbers just before that. Now on December 9th, we have PPI, we have just coming in November 30th, we have Fed Chair Powell talking. So we got unemployment, non-farm payrolls, ISM. We got a lot of data coming out. Now, this is on the back of already having deeply inverted yield curves. The 10-year and 3-month, we haven't seen it this inverted at 73 basis points inverted since about late 2000, which was obviously around the dot-com bust. And then you have the 10-year 2-year curve, 10-year minus 2-year, is at 74 basis points of inverted, which we haven't seen since the 80s. This is also during the time where quantitative tightening picked up this year, right? It topped around March, and the Fed balance sheet has been in this massive reduction phase, full pedal to the metal, right? Going down, and it's still going to continue to do that. At least that's what they say for right now, which creates illiquid markets. You typically see more volatility, which we have been seeing during that time. And then you talk about, on top of all of that, you have them raising rates at a very rapid move. You can see in 2018, which is right here, there was some very strong similarities at the end of the year between 2018 and what we see now, where you get holiday trade that pushes up. But then December, we were quantitative tightening, and then on top of that, we were raising rates, and we saw the markets kind of fall apart. Is that going to happen this year? I couldn't tell you. We got to at least be prepared for that to potentially happen. But you can see the rate at which we're moving right now is pretty darn aggressive, and you can see that there's still no stop in sight as it stands this current moment. In December, there's a 75% probability that we are moving them up another 50 basis points. Now remember, they're data dependent. So are they going to be doing it 75 basis points if inflation continues to run rampant, or are they going to even do it less? It's going to really depend on that inflation data that it comes out the day before the Fed meeting. So that's going to be pretty interesting. Now, even come February of next year, there's still a 52% probability as it stands right now that we're going to see another rate hike. So they are, like I said, they're raising rates, they're tightening their balance sheet, and this creates illiquid markets. Now, if you take a look at the expected moves for the month and quarter, the solid line is going to be the month to date, and the dash line is the quarterly expected move. So if we do get some holiday trade that pushes up further, there's a strong possibility that we can still have room to go. Now, we are just still this red shaded area. We're well into bear market territory still at this time. So when we get out of it, you want to start looking above, 325 to feel a little bit more confident that we might be out of bear market territory in the Qs, that is, okay? Now, earlier this month, we tagged the lower monthly expected move on the T, and we started rallying from that point. If you take a look at IWM, we're floating right around the quarterly expected move, and we still have another quarter to go, but we are still below that monthly expected move. So if we come up to tag that, it'd bring the IWM out of bear market territory, but if it pushes back down, we'd be right back in it. Now, the S&P 500 is also floating right around quarterly expected move and also right around that monthly expected move at about 4,100. So those are some interesting levels to pay attention to coming into month end, which we're right about here. But then also to note that, hey, there's still a lot of downside potentially in this quarter. Not to say that that's going to be the case as we're trading outside of that bear market territory, but if we get outside of the quarter, there's a 68% probability that we close, within this quarterly expected move. So if we come outside of it, there's still a high probability chance that we end up closing still within those levels. Now, if you take a look here on the S&P 500 weekly expected move, we tagged it just last week. That was the last week's weekly expected move where that dashed line is. And we're still floating, obviously, in a down channel, which means we have a series of lower highs and lower lows. And we're right below that 200-day. We're right below the trend line. And if we take a look at this chart, you'll see the updated weekly expected move is around 4,100, 39.50. I'll have you screenshot it here momentarily. But you can see also the histogram on the MACD, you can see that it is putting in lower highs while the price action is continuing to press higher, which I have some interesting divergences to show you later. Go ahead and screenshot this if you want the weekly expected moves for the SPX, the SPY, the Qs, the IWM, and the Dow Jones, the diamonds going into next week. This right here is the closing price. This right here is the weekly expected move. This is the upper level. This is the lower level. Now, if we continue on, what I find interesting as price action's pressing up higher into these areas, VIX has been getting completely, VIX has been getting completely crushed. As you can see, it's been heading down. We have a RSI reading that we haven't seen for years. You can see here, dating back to 2018, we haven't had a reading that low. But what I do find interesting is volatility of volatility. The VVIX is starting to uptick. Meanwhile, the skew as well, we are starting to see a pretty sharp increase in skew, which tells me that people can be reaching here for protection. What does that mean? We'll know when we know, but we got to be aware of that taking place. Big players could very well be hedging their books. They can be, like I said, reaching for protection coming into the end of this month as well as the beginning of the next month. So despite even knowing that we get month-end markup, we got to be prepared and we got to be just aware of that the market can very well turn on a dime, right? Especially these illiquid markets. Now, if we take a look at this weekly performance, if you look at the top performing sector, utilities, consumer staples, materials, right? So utilities and consumer staples, and even healthcare, they're all up there. And these are defensive posturing. So not only do we have a decent week, right, during this holiday trade, but it's a little bit defensive posturing taking place, as you can see right now. And if you look year to date, you had energy being the top performer. It's up 70%. Now, this is where it gets pretty interesting. Utilities, consumer staples, healthcare, all defensive posturing all year. Okay, and then you start to see these ones start to creep back up in the rankings, but still very defensive posturing overall. Now, this is kind of where I find it to get a little bit interesting. Energy sector. Energy sector right here is below us, XLE. Oil is right here above us, and this will all tie in, but you can see on a 90-day correlation, which is 3 months, we'll call it a quarter, it's typically a positive correlation, meaning that oil has a very strong positive correlation to energy stocks. We already know this. I don't know what I just did right there. I keep on doing that. Energy stocks are typically highly correlated to oil. Now, what I find interesting here is there's been a couple of times, in the last since 2018 where it dips into negative territory or we have basically no correlation. And the last time over here, this was when, oil was kind of just trickling up and then going sideways. But at the same time, energy XLE was kind of heading straight down. Now, this was interesting because what happened there shortly after? Well, oil started move up higher, and then energy stocks started to continue that trend back up. So that divergence led to a big move here in 2021 and even 2022. Now we're back here again, but there's a subtle difference. Oil is not heading up. Oil is heading down, and what is energy doing? It's going up. So back here was going down while this was going up. This is going down now while this is going up. Is energy going to start correlating again to oil? And if so, does that mean that it's going to catch to the downside, meaning that energy stocks may be finding some sort of a top here in the very near future? Now, what I also find interesting is looking at a larger time frame. If you take a look at oil rate of change on a monthly time frame, right, a year rate of change, right, 12 months, you can see that when we got these very excessive readings at around 100%, these large spikes, these rapid moves in oil led to some bear markets. And you can see that here. We have the 1987 crash, 1990 dot-com financial crisis, and we have this taking place currently right now. Now, if we look on this on another level, the dollar has a very strong correlation typically to commodities and even to oil. And typically it's a negative correlation. The negative correlation means that if the dollar goes down, oil goes up. But what do we see taking place here? Well, we're looking at shorter time frame right here, so 15-day, 30-day. okay? These are the longer time frames, 120 and 180. So the longer time frames are still showing a negative correlation, okay, but they're starting to turn up. But look at the shorter time frames. They're starting to have a positive correlation to the dollar. So as the dollar has been falling, right? The dollar has been falling, oil has been falling with it, creating a positive correlation. And that's interesting because, like I said, there's typically a negative correlation. So this, to me, seems very risk-off type of behavior building, and it seems very well like these are the early signs of a potential recession. Now, if we keep continuing on, this right here is something I posted way back in May, and when bonds, okay, we're looking at bonds right here. This USB, we'll use that as a proxy, begins outperforming CRB, which is commodities. Utilities, a defensive sector, starts outperforming the SPY. Okay, so when bonds outperform CRB, utilities typically outperform the SPY. But during this entire year, utilities have already been outperforming the SPY. As we've already showed right here, they've been one of the top performers all year. They're actually positive on the year while the SPY is down. Okay, and that was happening pretty much at the same time CRB. And the reason why I'm talking about CRB is because one of the big components is energy, is outperforming bonds, okay? Now, if you look at a correlation chart, that's only happened, it says doesn't happen often, it happened in 1999 and 2008, which just so happens to be, boom, right before the great financial crisis and boom, right before the dot-com bust, okay? So what I find here that's taking place is you typically see these eventually correlations start to, head back down. You start to see them change. And what I got going on here is, you start to see this turn. This is the updated chart. And the reason why I'm pointing this out right now is because, well, if we go back over here, CRB is a big component, right? A big component of CRB is obviously energy stocks. And if I'm right about energy stocks starting to take a back seat here, okay, then we're going to start to see more of this. It means that utility defensive sectors can outperform the SPY. But the big thing here is bonds will begin outperforming the commodity index. So if bonds have been getting, like I said, been pointing out, completely beaten up all year, they're starting to catch a little bit of a bid right here. Now, it could very well just be moving to the upper part of this channel and we start to get hit back down. If bonds start outperforming, commodities, which they have been here in just, recent days, recent weeks. But remember, it's like, it doesn't mean to buy bonds right here. You got to see how they consolidate, what takes place. But this is very risk-off behavior. And this goes to my point here on stage one. Are we moving into the area of stage one where we're going into a contractionary phase in the business cycle where bonds start to outperform? But remember, stocks and commodities go down. Well, energy and oil are pointing to that as it stands right now. Now, there's other commodities and so forth that typically do good in this area. Typically, gold can do good. And well, what do you know? Gold is starting to perform. It busted out of this lower down trend line. It started to flag. It's moving up, right? It doesn't mean that you buy right here. You want to see it consolidate and start to set up and trade tactically in this environment. But you got to see this. Bonds are moving. Gold is moving. Oil is coming off. These are all like just signs pointing to moving into this contractionary phase here in the business cycle. If you take a look at copper, copper started breaking down. Now, there is typically a pretty strong correlation, right? They call it Dr. Copper to the S&P 500. And we pointed out many times that when they copper puts in a higher high, but S&P 500 puts in a higher low, and then S&P 500 puts in a lower low, you typically can get rallies. It's like divergences, right? So boom, boom, boom. And then right here, we even marked it at this bottom right here in October, and we started rallying. Well, as it stands right now, copper, these last week, 2 weeks, it got completely crushed. Whereas the S&P 500 just pulled down slightly and then started ripping back up. So if copper continues to head this trajectory down, right, stage one, you get commodities that get beaten up. This could very well pull the S&P 500, potentially in other assets, down beside it. But there's other divergences taking place. The Dow Jones Industrial Average has been on this monster move. So Dow Jones Industrial Average has just been on this monster tear. This could be an insane bear market rally. It's not even far off from, the 2022 high, to be honest. It's like 5 or 6% away. It's really close to it. However, transports, very interestingly enough, you typically can see divergences here, and transports didn't put quite in another higher high, whereas Dow Jones Industrials did. Now, these are the type of divergences that you want to watch because industrials, if they continue to run but transports doesn't match it, that could be a warning sign saying, hey, these might start to very well pull back down here in the near future. So we'll continue to watch and see how that develops. Another one to watch is housing compared to S&P 500. So I don't know why that keeps happening. S&P 500 is in red, HGX is in yellow, and you can see here we've seen many times where it doesn't put in a higher high right here, and then S&P 500 puts in a higher high, and you can see that multiple times here. Well, we're right back to where that was, and it's starting to happen again. Now, this can break, boom, we can start moving up, housing goes fine, and everything is fine, and the S&P 500 continues to rally, especially given that we're in a holiday season where you typically get positive trade. Okay, so that's always a possibility, but these are just subtle things to continue to pay attention to. Now, if we take one more look at something like lumber, and if you haven't read Michael Guyad's papers on, risk on, risk off indicators, I'd suggest you go do that. But lumber is looking very ill right here, right? You have this, move to the downside, and you have this very tight consolidation. So what does this mean? Well, expansion, boom, to the downside, leads to contraction. Contraction leads to expansion. That could be to the downside or the upside. Given the context of this chart, it looks like very sick. It looks like it's going to break down here in the near future. So continue to watch to see if that actually happens, right? It can fake us out, go up, and then break down, but just keep an eye here, because if that is the case, typically there's a strong correlation between lumber and housing, and if housing starts getting hit, it could very well follow, obviously, or if lumber gets hit, it can very well follow housing. So there's a lot of data here in today's episode, but it does, like I said, seems like despite being a positive time of the year for trade, it looks like risk signals are obviously continuing to build. We talked about the dollar moving up. We talked about bonds moving up. We talked about volatility even rising, right, and reaching for, obviously, protection. We talked about the indicators right here, which are just the yield curves being deeply inverted and the Fed raising rates, quantitative tightening. So you got to be on guard with this market rallying right here, all this FOMO, like a market bottom is in, it's game over. No, be careful, be 100% careful in this environment. The low for the year might be in, right? That's a positive sign, but it doesn't mean that this is the low moving forward, getting outside of this recessionary period, which clearly looks like we're potentially in right now or heading into. That's all I got for you on today's episode, everybody. See you later.